remaining questions of Section 6 corporations. Let's see what is the first question. Bhaskar formed Sun Enterprises LLC during the year. What form must Sun Enterprises LLC file in order to elect to be taxed as C corporation? Let's see the options. Option A, Form 1065 US Partnership Tax Return. B, Form 1120 US Corporation Income Tax Return. Option C, Form 7004 Application for Extension of Time to File for Corporations. Option D, Form 8832 Entity Classification Election. Let's see the answer. The answer is D. Let's see why it is D. So here Form 8832, also known as Entity Classification Election, it is used by eligible entities to elect how they want to be classified for federal tax purposes. This form allows entities such as limited liabilities company to choose whether to be taxed as C corporation, S corporation, partnership, or disregarded entity. The entity's chosen tax classification will determine how its income is taxed and reported. In this case, Bhaskar wants Sun Enterprises LLC to be taxed as C corporation. To make this election, Sun Enterprises LLC need to file Form 8832 and specify the desired tax classification on the form. This will inform the IRS of the entity's intended tax treatment. So option A is the correct answer. Let's go to the next question. XYZ, an eligible entity, made an election by filing Form 8832 Entity Classification Election on December 15, 2022 to be taxed as a partnership effective for January 1st, 2023. Under the general rule, what is the earliest date XYZ can elect to be taxed as a corporation by filing another Form 8832? Let's see the options. Option A, January 1st, 2023. Option B, January 1st, 2028. Option C, January 1st, 2029. Option D, December 15, 2028. Let's see the answer. The answer is B. Let's see why it is B. So under the general rule, an entity that has made an election to change its classification using Form 8832 must wait 60 months before it can make a new election to change its classification again. So this rule is designed to prevent frequent changes in tax classification. In this scenario, XYZ made an election to be taxed as a partnership on December 15, 2022. It wants to change its classification to be taxed as a corporation. To determine the earliest date XYZ can elect to be taxed as corporation, we need to count 60 months from the effective date. So since effective date of the election must be beginning of a tax year, the earliest date for the new election to be effective as a corporation is January 1st, 2028. Let's go to the next question. If taxpayer transfers property or money and property to a corporation solely in exchange for stock in that corporation other than non-qualified preferred stock, and immediately thereafter taxpayer is in control of the corporation. Let's see the option. Option A, the exchange is usually not taxable. B, the exchange is usually taxable to the corporation if the corporation is already operating. See, the exchange is usually not taxable to the taxpayer but only if the corporation is being formed. Option B, any gain or loss on the transfer is split between the taxpayer and the corporation. Let's see the answer. The answer is A. Let's see why it is A. When a taxpayer transfers property from when a taxpayer transfer property or money and property to corporation solely in exchange for stock in that corporation, and immediately thereafter the taxpayer is in control of the corporation, this is typically referred to as Section 351 transaction. So option A is the correct answer because the exchange is usually not taxable to either the taxpayer or the corporation in a Section 351 transaction, regardless of whether the corporation is being reformed or is already operating. Let's go to the next question. Jeevan transferred property worth 35,000 and renders services valued at 3,000 to a corporation in exchange for stock valued at 38,000. Right after the exchange, Jeevan owns 85% of the outstanding stock. What are the tax consequences to Jeevan? See the options. Option A, Jeevan recognizes ordinary income of 3,000 as payment for service rendered to the corporation. B, none of the choices. C, no gain is recognized on the exchange of the property. D, both, no gain is recognized on the exchange of the property, and Jeevan recognizes ordinary income of 3,000 as payment for service rendered to the corporation. Let's see the answer. The answer is D. Let's see why it is D. So in this scenario, Jeevan transferred property worth 35,000 and rendered services valued at 3,000 to the corporation in exchange for stock valued at 38,000. Right after the exchange, Jeevan owns 85% of the outstanding stock. So here, first thing is no gain is recognized on the exchange of the property, because when a taxpayer transfers property to a corporation in exchange for stock as a part of a Section 351 transaction, generally no gain or loss is recognized on the exchange of the property. This is because the transaction is considered non-taxable and the taxpayer's basis in the stock received is equal to the basis of the property transfer. And the second thing is Jeevan recognized ordinary income of 3,000 as payment for service rendered to the corporation. So when a taxpayer provides services to a corporation in exchange for stock, the value of the services is considered compensation income, and the taxpayer is required to recognize ordinary income in the amount of the value of the service rendered. In this case, Jeevan provided services valued at 3,000, so he needs to recognize ordinary income of 3,000. So the answer is 3,000. Let's go to the next question. Jagan and Ishwar combined their sole proprietorships by forming the Lyre Corporation. Jagan transfers land and building having a combined 50,000 adjusted basis and 100,000 FMV to the corporation in exchange for 40% of the Lyre Corporation stock. Ishwar transfers equipment with a 60% adjusted basis and 150,000 FMV to the corporation in exchange for 60% of the Lyre stock with a par value of 10%. Jagan and Ishwar received no other property than the Lyre stock. What is Ishwar's recognized gain on this transaction? Let's see the options. Option A 0, option B 90,000, option C 60,000, option D 150,000. Let's see the answer. The answer is A. Let's see why it is there. In this scenario, Jagan and Ishwar combine their sole proprietorship by forming the Lyre Corporation. They each contribute property to the corporation in exchange for stock. Let's first break down Ishwar's contribution and the tax consequences. Here, Ishwar transfer equipment with 60,000 adjusted basis and 150,000 FMV to the corporation in exchange for 60% of the Lyre Corporation stock with a par value of $10. So for tax purposes, when property is transferred to a corporation in exchange for stock, the general rule is that no gain or loss is recognized by the transferor if the exchange qualifies as Section 351 transaction. Here, because Ishwar is getting 60% of the Lyre stock and Jagan is also getting 40% of the stock. So here, together they have 100% of the stock. So they corporation is in the control of Jagan and Ishwar, so they qualify for Section 351 election. So Ishwar recognized gain on this transaction as 0. Let's go to the next question. Bhaskar and Farooq buy an apartment building for 100,000. Both Bhaskar and Farooq organize the Amar Property Corporation when the Amar apartment building has a FMV of 500,000. They transfer the building to the corporation for all of its authorized capital stock, which has a par value of 500,000. What is the gain, if any, that Bhaskar, Farooq, or the Amar Property Corporation must recognize? So the options: option A, Bhaskar none, Farooq none, Amar Property Corporation 500,000. B, Bhaskar none, Farooq none, Amar Property Corporation none. C. None of these choices. D. Bhaskar 250,000, Farooq 250,000, Amar Property Corporation 500,000. Let's see the answer. The answer is B. Let's see why it is B. In this scenario, Bhaskar and Farooq jointly buy an apartment building for 100,000. They they later organize the Amar Property Corporation, where the apartment building has FMV of 500,000. So they transfer the building to the corporation for all of its authorized capital stock, which has par value of 100,000. So they got 100% of the corporation. So the corporation is in the control of Bhaskar and Farooq. So they qualify for Section 351 election. So since they qualify for Section 351 election, no gain will be recognized for Bhaskar, Farooq and Amar. Let's go to the next question. Yuvraj Inc. directly owns stock of Alex Corporation. To determine if Alex Corporation is a member of controlled group with Yuvraj Inc. as a common parent, Yuvraj Inc. must own at least what percentage of the voting and total value of the Alex Corporation stock. Yuvraj Inc. directly owns stock of the Alex Corporation. So let's see the options. Option A 51%, option B 100%, option C 80%, option D 75%. Let's see the answer. The answer is C. Let's see why it is C. So, in order for a controlled group to exist, there are certain ownership thresholds that need to be met. A controlled group is a group of related corporations that are connected through ownership and have certain tax implications, such as consolidated tax return filing requirement. So, for Yuvraj Inc. to determine if Alex Corporation is a member of controlled group with Yuvraj Inc. as the common parent, Yuvraj Inc. must own at least 80% of both voting power and total value of Alex Corporation stock. This means that at least 80% of the shares with voting right and 80% of overall value of the stock must be owned by Yuvraj Inc. for the control group relationship to apply. The answer is 80%. Let's go to the next question. Arun contributes machinery and real property to Jagan Corporation that has been in existence for several years as follows. Asset machinery adjusted basis is 100,000, FMV is 150,000, real property adjusted basis is 500,000, FMV is 550,000. Jagan Corporation has two classes of stock, one with voting rights and one without voting rights. In exchange for the machinery and real property, Arun receives stock with FMV of 700,000. Immediately after the transfer, Arun owns 75% of the outstanding shares of corporate stock with voting power and 80% of the outstanding shares of each class of non-voting stock of the corporation. Which of the following statement is true? Let's see the option. Option A 100,000 gain is recognized by Arun. Option B 100,000 gain is recognized by Arun and corporation will recognize a loss in the amount of 100,000. Option C 100,000 loss is recognized by the corporation. D no gain is recognized by Arun. Let's see the answer. Answer is 100,000 gain is recognized by Arun. Let's see why it is 100,000. So in this scenario, Arun contributes machinery and real property to Jagan Corporation in exchange for stock. The key aspect here is that Arun receives stock with FMV of 700,000 in exchange for the property transfer. Here, he doesn't qualify for Section 351 election because To qualify for Section 351 election, they need to have 80% of the voting and non-voting stock. Here Arun has 75% of the outstanding shares. So here he doesn't qualify for Section 351 election. So he need to recognize the gain. Here adjusted basis is 600,000, FMB is 700,000. So the remaining 100,000 gain is recognized by Arun. 100,000 is a gain. Let's go to the next question. Bharat and Chari as a group transfer a building with a basis of 100,000 to the XYZ Corporation in exchange for 66.67% of each class of stock with the FMV of 300,000. The other 33.33% of the stock was already issued to Alex in previous year. What is the gain, if any, that Bharat Chari or the XYZ Corporation must recognize? A. Bharat and Chari 0, XYZ Corporation 0. Bharat and Chari 200,000, XYZ Corporation 0. Bharat and Chari 0, XYZ Corporation 300,000. B. Bharat and Chari 0, XYZ Corporation 200,000. Let's see the answer. The answer is B. Let's see why it is B. So in this scenario, Bharat and Chari as a group transfer a building with a basis of 100,000 to the XYZ Corporation in exchange for 66.67 of each class of stock with a FMV of 300,000. So here the tax consequences of this transactions are Bharat and Chari's gain is here building value is 100,000 and FMV is 300,000. The recognized gain is 200,000. 300,000 minus 100,000 is 200,000. And XYZ Corporation's gain is the XYZ Corporation does not recognize any gain in this situation because the corporation is issuing its stock in exchange for the property. And no gain or loss is recognized by the corporation in such exchanges. So only Bharat and Chari recognizes 200,000 gain and XYZ Corporation 0. So this reflects the recognized gain by Bharat and Chari and the fact that XYZ Corporation does not recognize any gain in this exchange. Let's go to the next question. Nag accepted stock in his employer's stock company valued at 1,000 instead of his 1,000 salary payment. Which tax consequence of this transaction is correct? A. No income to Nag because stock distributions are not taxable. B. No salary expense for his employer because no payment of salary was made. C. Nag must recognize 1,000 income because the stock is payment for services. D. This is a non-taxable exchange of property for stock. Let's see the answer. The answer is C. Let's see why it is C. So when an employee receives property including stock in exchange for their services, the value of the property received is generally considered taxable compensation income to the employee. This is true even if the employee did not receive cash but rather received property as payment for services. In this scenario, Nag accepted stock in his employer's company valued at 1,000 instead of 1,000 salary payment. Since the stock is received in exchange for Nag services, the value of the stock is considered taxable income to Nag. So the 1,000 value of the stock received is treated as compensation and Nag must recognize this amount as income on his tax return. Let's go to the next question. Tech Corporation was formed by three equal shareholders, Arun, Bhaskar and Charan. Charan agreed to provide all the legal work of organization and incorporation for 5,000 cash and 5,000 worth of stock in Tech Corporation. Which of the following statement regarding the exchange is true? A. Charan will recognize 5,000 in ordinary income. B. Charan will recognize 10,000 in ordinary income. C. Charan will recognize 5,000 ordinary income and 5,000 capital gain. D. Charan will not have to recognize any income because the transfer is non-taxable. Let's see the answer. The answer is B. Let's see why it is B. Here in this scenario, Charan provided legal work for the organization and incorporation of Tech Corporation. So, as compensation for his services, Charan received 5,000 in cash and 5,000 worth of stock in Tech Corporation. So here cash compensation, the 5,000 received in cash is considered ordinary income to Charan. This is because it represents payment for his service rendered, and such compensation is subject to ordinary income tax rates. And the 5,000 worth of stock received by Charan is also considered compensation for his services. The FMV of the stock received is treated as additional ordinary income. This is because the stock received for service is generally valued at its FMV, and the value is subject to ordinary income tax. As a result, the total amount of ordinary income that Charan must recognize is 10,000, which is 5,000 cash and 5,000 stock. So Charan will recognize 10,000 is in ordinary income. Let's go to the next question. Patel transferred property worth 50,000 to Vinod INC and also provides personal service worth 5,000 in exchange for stock valued at 55,000. Immediately after the exchange, Patel owns 90% of Vinod INC's outstanding stock. What is Patel's income recognition, if any? A. 55,000 capital gain, 0 ordinary income. B. 5,000 capital gain, 0 ordinary income. C. 0 capital gain, 50,000 ordinary income. D. 0 capital gain, 5,000 ordinary income. See the answer? The answer is D. Let's see why it is D. In this scenario, Patel transferred property worth 50,000 to Vinod INC and provides personal service worth 5,000 in exchange for stock valued at 55,000. So, property transfer, which is 50,000, the transfer of property worth 50,000 does not result in a recognized capital gain or loss for Patel, as it is considered non-taxable exchange of property for stock in a corporation, and the remaining the personal services provided by Patel have a FMV of 5,000. Since the services are provided in exchange for the stock, the FMV of the services is treated as ordinary income to Patel. So Patel will recognize 5,000 as ordinary income for the personal services provided. So there is no capital gain recognized because the property transfer is non-taxable. So 0 capital gain and 5,000 ordinary income. Let's go to the next question. Surya Corporation is a C corporation. James owned 80% of all the outstanding shares of Surya Corporation stock. Back in 1999, James advanced funds to Surya Corporation as a loan. The loan instrument executed between James and Surya Corporation is a demand loan. The principal balance due on the loan from Surya Corporation is 300,000. After James demanded repayment of the outstanding loan on March 20, Surya Corporation transferred to James preferred stock with FMV of 325,000 and settlement of the debt. James has the right to require Surya Corporation to redeem the preferred stock. Which of the following is true? Let's see the answer. Options. Option A, transfer of stock to James qualifies as a Section 351 transfer. Option B, transfer must recognize income on the transaction. Option C, transfer of stock to James in a Section 1244 qualified small business stock transaction. Option D, the transfer of stock is a non-taxable transaction because James is in the control of the corporation. Let's see the answer. The answer is B. Let's see why it is B. So here in this scenario, Surya Corporation transferred preferred stock to James in settlement of a debt. The key point to consider here is that James has the right to require Surya Corporation to redeem the preferred stock. This means that preferred stock is effectively a financial instrument that represents the repayment of the debt, and it's not a genuine equity ownership interest. So when a debt is settled by transferring stock or other property to the creditor is generally required to recognize income to the extent that value of the property received exceeds the creditor basis in the debt. In this scenario, the FMV value of the preferred stock received by James is 325,000. while the principal balance due on the loan is 300,000. So the excess of 25,000 would be recognized as ordinary income to James. So James must recognize income on the transaction. This is because the transaction involves the settlement of a debt using preferred stock, and the FMV of the stock received exceeds James' basis in the debt. Let's go to the next question. Dravid transfers real estate with a basis of 40,000 and FMV of 90,000 to a controlled corporation and in return for stock in the corporation. Just before the transfer, Dravid obtains a loan secured by real estate and uses the 10,000 loan proceeds to buy a new motorcycle. Along with the real estate, the mortgage is transferred to the corporation. Which of the following is true with regard to the tax consequences to Dravid? A. No bona fide business purpose exists for the corporation to assume Dravid's loan. B. Using the proceeds for personal purposes is like the corporation distributing cash, which would be taxed as boot under normal circumstances. C. The mortgage assumed by the corporation does not exceed his basis in the property transferred, but because this particular liability is considered boot, Dravid has to report a gain. D. All of those choices. Let's see the answer. The answer is all of those choices. Let's see why it is D. So here option A, if there is no legitimate business purpose for the corporation to assume the loan, it might indicate the transaction is structured in a way to artificially generate tax benefits. So option A statement is correct. Option B, when a corporation assumes a liability of the transferor, it generally treated as boot in the exchange. So if the loan proceeds are used for personal purposes, it's similar to receiving cash, which is considered boot and could result in taxable gain. And option C, even if the liability assumed by the corporation does not exceed Dravid's basis in the property transferred, if it is considered boot, Dravid might have to recognize gain to the extent of the boot. So all of these choices are the correct options. Let's go to the next question. Jagan, Madan, Sagar and Tarun organized JAMS Anti Corporation by transferring the following. Jagan transferred land with basis of 50,000, adjusted basis of 105,000 and got 37 shares of stock. Madan transferred equipment with basis of 35,000, adjusted basis is 44,000 and got 22 shares of stock. Sagar contributed tools with a basis of 45,000, adjusted basis of 45,000, FMV of 38,000 and got 19 shares of stock. So Tarun transferred cash adjusted basis of 44,000, FMV of 44,000 and consideration received is 22 shares of stock. Here the land contributed by Jagan is subject to mortgage in the amount of 30,000. JMS&T Corporation assumes Jagan's mortgage on the land. The 100 shares represent all of the outstanding stock of JMS&T Corporation. Which of the following is correct? So the options, option A, the exchange does not qualify for IRC section 351 non-taxable treatment. Option B, the exchange qualifies for IRC section 351 non-taxable treatment, but Jagan must recognize 30,000 of capital gain. C, the exchange qualifies for IRC section 351 non-taxable treatment. Option D, the exchange qualifies for IRC section 351 non-taxable treatment, but Jagan must recognize 30,000 of capital gain. Let's see the answer. The answer is C. Let's see why it is C. So here, based on the information provided, it seems the transfer are contributing property in exchange for stock, which is a common scenario for IRC section 351 treatment. So the fact that JMS&T Corporation assumes Jagan's mortgage on the land does not automatically disqualify the transaction from IRC section 351 treatment. So they qualify for section 351 taxable treatment. Let's go to the next question. Ravi transferred an office building that has an adjusted basis of 60,000 FMV of 105,000 to Varda Corporation in exchange for 100,000 of Varda Corporation stock and 10,000 cash. The building was subject to a mortgage of 25,000 which Varda Corporation assumed. The FMV of the stock was 75,000. What is the amount of Ravi's realized gain and recognized gain? Let's see the options. Option A, realized gain is 55,000, recognized is 30,000. Option B, realized is 50,000, recognized is 10,000. Option C, realized is 50,000, recognized is 30,000. Option D, realized is 35,000, recognized is 10,000. Let's see the answer. The answer is B. Let's see why it is B. So here, FMV of the stock received is 75,000 and cash received is 10,000 and liability assumed by corporation is 25,000. Total they received is Ravi received is 110,000 and minus, if we deduct adjusted basis, realized gain is 50,000 and recognized gain will be whatever the cash Ravi has received. In this case, Ravi has received 10,000 cash, so they have to recognize 10,000 as a recognized gain and realized gain is 50,000. Let's go to the next question. John transferred a factory building with an adjusted basis of 70,000 and FMV of 110,000 to Kaveri Corporation in exchange for 100% of Kaveri Corporation stock and 20% cash. The building was subject to mortgage of 25,000 which Kaveri Corporation assumed. The FMV of the stock was 75,000. What is the amount of John's realized gain and recognized gain? So the options. Option A, realized is 50,000, recognized is 20,000. Realized is 25,000. Recognized is 25,000. C option. Recognized realized is 50,000. Recognized is 40,000. Option D, realized is 35,000. Recognized is 20,000. Let's see the answer. The answer is A. Let's see why it is A. So here, John received property with FMV of 75,000 and cash is 20,000. Liability assumed is 25,000. So total received is 120,000, but his basis in the property is 70,000. So remaining 50,000 will be his realized gain, but recognized gain will be whatever cash he has received. He received 20,000, so realized gain is 50,000 and recognized gain is 20,000. Let's go to the next question. Sarita transferred property to a corporation for stock. Immediately after the transfer, Sarita was in control of the corporation. She also received 10,000 cash in the exchange. Her adjusted basis in the transferred property is 20,000. The stock she received has FMV of 16,000. The corporation also assumed 5,000 mortgage on the property, for which she is personally liable. What is Sarita's recognized gain, if any? See the options. Option A 10,000, option B 11,000, option C 15,000, option D 0. See the answer. The answer is A 10,000. Let's see why it is A. So here FMV of the stock received is what Sarita has received is 16,000, cash received is 10,000, liability assumed is 5,000. So total received is 31,000. And the adjusted basis which they received is 20,000. So realized gain will be 11,000, but recognized gain will be whatever the cash Sarita has received. So Sarita has received 10,000, so recognized gain is 10,000. Let's go to the next question. Madhuri owns a farm with an adjusted basis of 500,000 and a mortgage of 200,000. She exchanged the farm for stock in a transfer under IRC section 350. What is her basis in the new stock? Let's see the options. Option A 700,000, option B 300,000, option C 200,000, option D 500,000. Let's see the answer. The answer is B, 300,000. Let's see why it is B. So here in a transfer under IRC section 351, the basis of the stock received by the shareholder is generally equal to the adjusted basis of the property transfer, and which will be decreased by any basis, any liabilities assumed by the corporation. Here, basis in the stock will be adjusted basis minus liabilities assumed. So here basis is 500,000 and mortgage is 200,000. So basis in the new stock will be the difference of adjusted basis and liability assumed. So which is 300,000. Madhuri basis in the new stock is 300,000. Let's go to the next question. Sarita contracted with Dawan Corporation to perform engineering service during the year. Her contract specified she would receive 100,000 for the service rendered. Upon completion of her contract, Sarita decided to accept a payment offer from Dawan Corporation of 60,000 in cash and 1,000 shares of their stock. At the time she was paid, Dawan Corporation stock was trading for 45 per share. If Sarita reported on an individual return the appropriate amount for her services, what would be her basis in her 1,000 shares of Dawan Corporation stock? Let's see the options. Option A 0, option B 45,000, option C none of the above, option D 40,000. Let's see the answer. The answer is B 45,000. Let's see why it is B. So here Sarita's basis in the 1,000 shares of Dawan Corporation stock is determined by the FMV of the property received as compensation for her services. In this case, she received 1,000 share of stock and each share had FMV of 45 at the time she received it. So basis in the stock is number of shares, which is 1,000, and FMV is 45. So total is 45,000. So Sarita's basis in her 1,000 shares of Dawan Corporation stock is 45,000. Let's go to the next question. Corporation generally must make estimated tax payment if they expect their estimated tax income tax less credit to be equal to 2 or more than 8,000, B 500, C 600, D 1. Let's see the answer. The answer is B. Let's see why it is B. So here corporations are required to make estimated tax payment if they expect their estimated liability to be 500 or more for the tax year. This means that if the corporation anticipates owing at least 500 in taxes after considering any credit, it must make estimated tax payment to the IRS throughout the year to meet its tax obligation. So the answer is B 500. Let's go to the next question. For a corporation is required to make, if a corporation is required to make estimated tax payment because it expects its tax to be 500 or more for the year, the first installment payment of estimated tax is due by A 15th day of the 6th month of the corporation's tax year, B the 15th day of the 3rd month of the corporation's tax year, C the 15th day of the 5th month of the corporation's tax year, D 15th day of the 4th month of the corporation's tax year. Let's see the answer. The answer is D. Let's see why it is D. So a corporation that are required to make estimated tax payment, the first installment payment of the estimated tax is due by 15th day of the 4th month of the corporation's tax year. This is the initial payment made towards the estimated tax liability for the current tax year. Subsequent estimated tax payments are typically due on 15th day of the 6th, 9th and 12th months of the corporation tax year. Let's go to the next question. Kaveri Corporation has a fiscal year beginning September 1st, ending August 31st. Kaveri's estimated tax for the fiscal year beginning September 1st, 2022 is 10,000. The first installment of Kaveri Corporation estimated tax would be due by A. January 1st, 2023, B. December 15, 2022, C. January 15, 2023, D. December 1st, 2022. See the answer. The answer is B. Let's see why it is B. For corporation that has a fiscal year ending on August 31st, the first installment of estimated tax is due by 15th day of the 12th month of the preceding tax. In this case, the fiscal year begins on September 1st, 2022 and ends on August 31st, 2023. So the first installment of estimated tax for this fiscal year would be December 15, 2023. 2022. So let's go to the next question. The Sun Corporation, a calendar year taxpayer, estimates at the end of the March that its federal income tax for the year will be 800,000. It pays 200,000 of the estimated tax by April 18th and pays another 200,000 on June 15th. At the end of the August, a recalculation shows that its tax is expected to be 900,000. Which of the following is correct? Let's see the options. Option A, payment due September 15th to 50,000, payment due December 15th to 50,000, payment due September 15th 200,000, payment due December 15th 300,000, payment due September 15th to 75,000, payment due December 15th to 25,000, payment due September 15th 200,000, payment due December 15th 200,000, payment due on March 15th 100,000. Let's see the answer. The answer is C. Let's see why it is C. Here, amended total estimated tax payments is 900,000, which is multiplied by the next two payments, which is 50% if the next payment is due on June 15, 75% if the next payment is due on September 15. So it is next payment due on September 15. So it is 75%. So 900,000 into 75% is 675,000. Less estimated tax for all the previous year. Already they have paid 400,000. So the next payment is 275,000. So September 15th it is 275,000 and December 15th it is 225,000. Let's go to the next question. The ABC Corporation, a calendar year taxpayer, estimates at the end of the March that its federal income tax for the year will be 800,000. Accordingly, it pays 200,000, which is 25% of 800,000 into 100% by April 15th and another 200,000 by June 15th. At the end of the August, a recalculation shows that a tax for the year is expected to be 100,000. 100,000. Assuming that there is no later change in the estimated tax, what should be estimated tax installment for September? A 200,000, B 350,000, C 0, D 400,000. Let's see the answer. The answer is B. Let's see why it is B. So here amended estimated tax is 100,000 and which is like 50% is if it is next June 15th and 75% if it is due on September 15th. So as it is September 15th, 75%, which is 750,000. Already they have paid 400,000 estimated tax. So remaining tax due for the September 15th is 350,000. So the answer is 350,000. So let's discuss the remaining questions in the next session.